Subscribe to LearnCab and hit the bell icon to get notified.
Audit of life insurance companies. Now, my dear soldiers, is the second part of discussion. And let me remind you that audit of life insurance company is not applicable to old syllabus CA final. It is only applicable to new syllabus CA final. Audit of life insurance company, first of all, life insurance basically it covers the risk related to the person. So it is more related to person, whereas general insurance is more related to goods, events or asset. So life insurance is more related to covering the risk related to person. First of all, let us try to understand the different types of life insurance product. The first one is the term insurance or the protection insurance. Term insurance or protection insurance. Basically, the agent will never talk about this particular policy, or he will always underplay this policy, because this policy will not give him much commission. That is one thing. But what is term insurance or protection insurance? Basically, we call it as a pure insurance whereby you just make the payment of premium and anything related to your life, risk related to life is covered. Say for example, something happens to a policy holder. So for example, person dies, then the family member will get it. It's a pure insurance. Okay, that is term or protection insurance. I always tell my students that three insurance which you should compulsory have is, one is the vehicle insurance. I mean, show me any vehicle which does not have a dent. The first dent which happens, you don't sleep whole night. You are so disturbed. You're so disturbed, oh my God, my vehicle. And then afterwards, second, third dent, okay, no problem. Dent per dent, no problem. But first dent, no, it affects you a lot. You think a lot, array, what happened, another thing. So that is what, my dear soldiers, is the aspect related to insurance. Okay. So the second thing, insurance, which I always advise them is Mediclaim, and third one is this term insurance. Please have these three compulsory insurance. Mediclaim also today, the cost of hospitalization is very high. So we said, okay, at least that Mediclaim should be there. Okay. So the reason why agents don't highlight much about this insurance is because the commission cost. Okay, that's the thing. It's a pure income replacement, and it's not needs rather than capital appreciation. So my dear soldiers, understand that if anything happens to a person, his family will be compensated. And next one, you have endowment insurance. Now endowment insurance, what happens? It is more like an investment plan. At the end of policy, say after 5 years or 10 years, you'll get the money. You'll get the sum assured after a certain point of time. That is called as endowment insurance. So here, cover the risk for a specified period at the end of the policy, sum assured is paid to the policy holder. And then you have money back policy. In case of money back policy, what happens in this insurance, you will get the money at a regular intervals. A person will get. So this is also similar to endowment insurance. But in endowment, what happens, my dear soldiers, at the end of the policy holder will receive the money. Whereas in case of a money back policy, it is very clear that this particular type of policy, what happens is that you will get the amount of insurance, when you will get the amount of insurance at a regular interval. So this comes only at the regular interval. That's the thing. Okay, that is called as the money back policy. Okay, so periodic payment is done. In fact, one of my friend, he took a money back policy. He said that he told the agent that when my son comes to say 7th standard, I require some money for his high school education. And then when he comes to 10th for college, I require some money. Then when he comes to 12th, I require some money. And then when he goes for higher studies abroad, I require some money. Even for his marriage, like that, he planned up. So he planned up some 15-20 years ahead for his child. That is called as money back policy. Very intelligently driven, because at that point of time, if you multiply with inflationary factors and okay, at this point of time I should get 10 lakhs, and what happens, everything will be matched. So that is the beauty of what come on money back policy. or money back plan, what we can say. And so you get payment on periodic basis, that's it. Okay, partial benefits are received actually. So it is not complete benefit, but partial benefits are received and to the policy holder. And in the event of death, the policy term death claim would be comprised of full sum assured, so without deduction of any survival benefit amount. So if a person dies in between, then he is given a full amount of whatever that is sum that is assured. And next one, what you have is for whole life insurance product. Whole life insurance product, that's a thing. My dear soldiers, understand that whole life, it covers throughout the lifetime of the person. You may stop paying the premium after 10 years, but after that also the risk will be covered. That is called as whole life insurance product. One of the product of LIC was Jeevan Anand. The Jeevan Anand was one thing where even if the policy is getting over, after that, after 10 years also, it will be covering your whole life. This is a very good product, whole life insurance product. Okay, it covers throughout the lifetime of the person. And other type of insurance product are unit linked insurance plan. Basically these products are linked with the stock market. Okay, it depends upon the investing assets. So what happened, the value of policy changes as per the underlying asset. So it depends upon the stock market shares which are listed. And then you have pension or retirement funds. So there will be an age, you will define an age. After 55 years, I should get regular pension, or after 50 years, I should get regular pension. So there is an age which will be defined, that is called as pension or retirement plan. Okay, pension or retirement plan. So that is a age which is defined. So this is the thing actually. So retirement solution, where policyholder decide retirement age and agrees to pay premium till the time of the retirement. He has the option to commute to a part of its fund value and take annuity for the balance. So you can take lump sum also, and you can partially you can take lump sum, and you can say, okay, I should get regular annuity on a regular basis, means on a monthly basis I should get the return. And then we have annuities. So annuity is purely regular interval, the insurer will pay the money actually to the policy holder. So that's the thing. So that is called as annuity. Okay, so series agreed payment at regular intervals from the fixed date. Okay, regular interval it is being paid. Money back policy and annuity difference is that annuity, the frequency is very high, monthly basis, quarterly basis, whereas when it comes to money back policy, you will get only after certain point of time, say after 3 years, after 5 years. And then we have group insurance. Basically group insurance is taken by the company for its employees. It covers its employees actually, that is covered under the group insurance. Okay, so these are the various types of insurance products which we come across. These are the various different types of products to be covered, that is the types of life insurance products. Okay, then next one. So this covers, basically they are all members of society, employees or of an organization. For those people, group insurance is very much useful. And then my dear soldiers, we have other things. So we talk about the accounting policy, applicability of accounting standards. So if you talk about insurance company, the financial statement of the insurance company comprises of balance sheet, then P&L, then revenue account, receipts and payment account, and also you have cash flow statement. Then my dear soldiers, also various accounts are there actually. So now these are the financial statements of the insurance company, the balance sheet, the revenue account, the receipts and payment account, profit and loss. So they should be complying with the accounting standards issued by ICI. Okay, but whereas when it comes to cash flow, they have to follow only direct method. Only direct method should be followed while preparing the cash flow statement as far as the insurance company is concerned. And they have to follow AS 17. Segment reporting shall apply to all insurer irrespective of the requirements regarding the listing or turnover mentioned. They say it is a mandatory application of AS 17 as far as the insurers are concerned. AS 17 is more about segment reporting, and product wise segments you can do, or you can have a geographical segments. Okay, so this is the thing. So you should comply with accounting standards issued by ICI. And then when it comes to premium, in case of premium, my dear soldiers, premium shall be recognized when the income is due. So in this challenge here is that you will have an unearned premium. So unearned premium and earned premium you should segregate, and only earned premium should be offered as an income. Unearned premium should be taken as an asset. It should be carried forward, and maybe, like say, it is more like a liability as such. So it's not earned, but you have received in advance. So that is called as unearned premium. So unearned premium also again should be carried forward and recognized as an income. If you read General Insurance Company Audit, you had a concept of unexpired risk reserve. The same aspect becomes unearned premium. And then acquisition cost. What is the cost of acquiring the insurance policy? Because commission is paid to the agent. So that shall be expensed in the period in which they are incurred. That is acquisition cost. And when it comes to claims, my dear soldiers, claims may comprise the policy benefit amount and the specific claims settlement cost. So it comprises of policy benefit amount and specific claims settlement cost. That's a thing. So this is one thing, my dear soldiers, the policy benefit amount and the specific claims settlement cost actually. So that is what we understand by the claims. That's a thing. Then, so this is nothing but what, my dear soldiers, the cost. This is all about the cost which is incurred. That is the claims account. And then you also have, my dear soldiers, actuarial valuation, liability for life policies. Liability for life policies, that's a thing. So estimation of liability against life policy shall be determined by the appointed actuary of the insurer pursuant to his annual investigation of the life insurance business. So basically what happens, how much premium should be charged and what is the amount of claim for a particular premium, as per age of a person it is decided. So actuarial valuation is very much important, because how you should price, how you should charge the premium, for that purpose it is required. So the estimation of liability against a life policy is determined by the actuary. So actuary is one person, in simple terms I can tell, he is expert in maths and stats. That is the meaning of actuary. So he will do a thorough investigation and come out that for this amount of liability, this is a kind of policy can be issued, and this is the amount of premium that can be collected. Further, my dear soldiers, investments, because insurance company will have lot of investments, so there will be accounting policy related to even the investments. The investment in real estate investment property, which is used to either earn rent or it is purely meant for what, come on, the capital appreciation. The capital appreciation, that's a thing. So you need to determine the historical cost. Historical cost should be ascertained. Gains, losses arising due to changes in the carrying amount of real estate shall be taken to equity under revaluation reserve. Under what, come on, the revaluation reserve. So you should also calculate the gains, losses arising due to changes in the carrying amount of real estate shall be taken to equity under the revaluation reserve. That's the thing. And an impairment loss of shall be recognized as an expense in the revenue or profit and loss account immediately, unless the asset is carried at the revalued amount. Okay, that's the thing. So you should recognize the impairment losses for all the investment property. Impairment losses will be considered. Okay, so impairment losses basically where the carrying value of asset is more than the realizable value of asset. So you need to recognize that as an impairment loss. Okay, unless you have asset is carried at the revalued amount, then that's a different thing. And coming up to what, my dear soldiers, the debt security. The other type of investment which is made by insurance company is the debt security. Debt securities, including government securities and redeemable preference shares, shall be held to maturity securities and shall be measured at a historical cost subject to amortization. So any debt security, government securities, redeemable preference shares, it shall be considered as held to maturity. Held to maturity means it is valued at a historical cost. Okay, but again certain amortization will also be done. And coming up to the next type of investment is equity and derivative instrument that are traded in the market. So the listed equity, security or derivative, they are traded in active market, it will be measured at a fair value on the balance sheet date. Fair value, you have to take a fair value, and whatever differences which comes, you have to transfer it to fair value change account. Calculation of fair value, the lowest of the last quoted closing price at the stock exchange where the securities are listed shall be taken. So you have to take that particular price actually, which is quoted the last quoted closing price at the stock exchange. So lowest of the last quoted price in the stock exchange, that is a value should be taken. Fine, my dear soldiers. Then in case of investments, what happens? Investment should be made accordance with the statutory requirement and should be disclosed in a separate amount, nature, security and special rights and outside India. So make a complete disclosure what investments are, whether these investments are in India, whether these investments are outside India, what is the nature, security, special rights which are related to these investments in India or outside India. You have to make a separate disclosure of the same. Segregation into performing and non-performing investment for the purpose of income recognition direction issued by authority, because you would have made investments but you are not receiving the interest regularly, dividend regularly. So is it a performing investment or a non-performing investment? Again, as per IRDA guidelines, you have to go. Then asset to the extent required to be deposited under local laws are otherwise encumbered. So whatever investments you have to make with the central government and state government securities, it has to be followed. See, please understand, once the insurance company will collect the premium, now they have huge amount of funds available. Like take example of life insurance corporation, LIC. LIC has got huge amount, my dear soldiers, available. So what is these assets which are being used? How they are being utilized? How they are being used? That is also to be taken. So asset to the extent required to be deposited under local laws are otherwise encumbered. And then percentage of business sector wise. So you have to calculate the percentage of the business sector wise, that is another thing. And then a summary of financial statement for last 5 years in the manner as may be prescribed by the authority. So you need to obtain a summary of financial statement for last 5 years. So what is the summary of financial statement last 5 years, which is prescribed by the authority, IRDA. Then basis of allocation of investment and income thereon between policy holders account. So how much investments can be made, even that is also prescribed, and how much investment can be made using policy holders account. In fact, you cannot use policy holders account to make investment outside India. There are restrictions. You can use shareholders funds to invest outside India. Policy holders fund should not be used to make investment outside India. And then accounting ratios may be prescribed by the authority. What is the accounting ratio? So are they making investment within that limits? How much investments they can make in unapproved securities, even that is also highlighted here. Further, my dear soldiers, all significant accounting policies should be as per the accounting standard issued by ICI. Whatever principles, policies are there, that has to be followed as per accounting standard issued by ICI, and a complete disclosure of accounting policy should be done as per AS1. And any departure from the accounting policy, in such case, you have to make a disclosure why such departure from accounting policy is being done. A reason has to be given for such departure. Okay. Fine, my dear soldiers. I hope you are clear with the introduction on the life insurance companies. I'll see you in the next video. Thank you very much, my dear soldiers.